Okay, let's jump right into this explainer because today we're unpacking a modern financial illusion that is quietly trapping tens of millions of Americans. We are talking about a system brilliantly designed to look like, just a simple convenience at checkout, but which actually operates as a massive, completely invisible credit network. We're talking about the buy now, pay later industry. To really understand the sheer scale and the danger of this trap, we kind of have to look past the slick marketing and examine what is actually happening inside the bank accounts of everyday people. To see exactly how this invisible trap snaps shut, I want you to consider the story of a 27-year-old graphic designer in Austin, Texas. On the morning of March 7th, she opened her banking app and was greeted by a negative balance of $412. And here's the crazy part. She had been paid just 2 days earlier. So obviously, she scrolled through her transactions looking for fraud, looking for a glitch, looking for literally anything that didn't belong. But everything belonged. Every single charge was hers. She just couldn't remember agreeing to all of them. Her name wasn't on a payday loan, she hadn't maxed out a traditional credit card, and she certainly had never walked into a bank and asked for a loan. Now, what's genuinely fascinating about this situation is how she actually arrived there. What she had done over the course of about 14 months was just tap a little button that said Pay in 4 on practically every online purchase she made. You know the drill. A pair of running shoes here, a skincare set there, maybe a birthday gift, a jacket, a phone case. Each one felt incredibly small, practically harmless, just disappearing into the rhythm of her everyday life. But by the time she finally sat down and added up every single active installment plan across Klarna, Afterpay, and Affirm, she owed $3,800. Let that sink in. She didn't even know this number until she wrote it down on paper. She was carrying nearly $4,000 in debt that no bank, no lender, and no credit bureau could even see. Section 1. The Invisible Debt Trap. How small clicks create massive balances. See, users genuinely believe they're managing their money responsibly by avoiding interest. They think they're managing cash flow exactly the way the checkout page encourages them to. But let's contrast that super consumer-friendly marketing pitch with the brutal reality. The pitch is, well, it's beautiful, right? You pay 25% upfront, the rest gets split into 3 more payments over 6 weeks. There's zero interest, no hard credit check, instant approval. Boom. A $100 purchase is just 4 easy payments of $25. Who could object to that? But the reality is exactly what showed up in the Austin designer's bank account. She wasn't just making one purchase. She was stacking all these overlapping installment plans that decided to auto-draft from her checking account weeks later, right alongside her rent. Section 2. The math behind the pitch. You are not taking out just one loan. To really grasp the scale here, we have to look at the numbers from the Consumer Financial Protection Bureau's market report. Buy now, pay later originations across the top providers reached 335.8 million loans in a single year. That's over $45 billion. Now, the average loan size? A tiny $135. But, and this is absolutely crucial, the average borrower wasn't taking out one loan. They were taking out 6.3 loans per year, per lender. And since a lot of people use 2 platforms, your real annual number is closer to 12 or 13 separate installment plans running simultaneously. This brilliantly illustrates that the Austin designer wasn't reckless at all. She was actually just average. The typical BNPL borrower holds over $22,000 in total unsecured consumer debt, and buy now, pay later makes up about 17% of that total. So much for the illusion of it being a safe alternative. So the real kicker here is that folks splitting purchases into 4 payments are actually stacking debt, not avoiding it. The data shows buy now, pay later users carry, on average, $871 more in credit card debt than non-users, and $453 more in personal loans. This completely destroys the narrative that people are using these little installment plans to stay away from high-interest credit cards. Actually, they're using them in addition to everything else. Section 3. Revealing the Phantom Debt, a system designed not to see you. You might be wondering, why didn't the designer see this coming? Well, because the system is explicitly built to keep traditional lenders completely blind to your real liabilities. Regulators actually call this phantom debt. Think about it. When you tap Pay in 4, no hard credit inquiry hits your report. No new account opens on your credit file. Most major providers literally do not report these loans to the major credit bureaus at all. Your FICO score is completely oblivious. You could tap Pay in 4, rack up debt, and then apply for a car loan the very next morning, and that car lender sees someone with 0 installment obligations. That is not a glitch. That is the entire design of the system. This quote right here, from a former executive reported by TechCrunch in November 2025, just perfectly captures the absolute chaos. Because the providers aren't talking to the credit bureaus. They aren't talking to each other either. Just like the designer in Austin who had active loans on 3 platforms at the exact same time. None of them knew the others existed. They are quite literally lending into a void.
Section 4. The true cost of later, when easy payments fail.
While 62% of users wrongly believe that using Buy Now, Pay Later actually builds their credit score, the truth is most providers give you 0 credit for paying on time. They don't report your good behavior at all. But oh man, they will brutally penalize you the moment you slip up. Miss a payment? Klarna triggers a $7 late fee after 10 days, capping out at 25% of the purchase price. Afterpay hits you with $8 or 25% of the transaction, whichever is less. And if you default entirely, well, they send the account to collections, slapping a permanent mark on your credit for 7 long years. It is an invisible upside with a completely catastrophic downside. And the situation on the ground is deteriorating really fast. These numbers from LendingTree's April 2026 report are just a grim evolution. Nearly half, 47% of users made a late payment in the past year. That is a massive 13% jump in just 2 years. But honestly, the most alarming stat is that middle one. 29% of users and a whopping 38% of Gen Z users are now using Buy Now, Pay Later to buy groceries. Over 60% of parents using the service say they couldn't make ends meet without it. Buy Now, Pay Later is no longer just a fun convenience for buying shoes online. It is mutated into a desperate survival mechanism for American households who literally can't afford to eat without borrowing.
And we absolutely have to talk about the long-term wealth destruction happening behind the scenes here. Let's calculate the opportunity cost for our Austin designer. She rotated through an average active balance of $1,900. If she had taken that money, didn't buy the stuff, and instead invested it in a basic S&P 500 index fund earning an average of 10% annually over 30 years, it would be worth over $33,000. She didn't just lose the $3,800 she owed, she effectively surrendered over $33,000 of her future wealth to tiny and visible checkout clicks. Section 5. The Regulatory Wild West, a $70 billion blind spot.
You know, this isn't just one person's problem. The Richmond Federal Reserve estimated this parallel credit system hit $70 billion in transaction value in 2025, yet regulators have completely struggled to keep up. The CFPB tried to enforce basic protections, like dispute rights and refunds, by classifying these providers as credit card issuers back in May 2024. But just 1 year later, in May 2025, they withdrew the rule entirely, confirming no replacement was coming. So this leaves a $70 billion industry with less oversight than a 1985 department store credit card.
However, the landscape is violently shifting. The checkout page isn't going to tell you this, but FICO announced they would begin incorporating this data into credit scores in the fall of 2025. They are finally forcing this phantom debt out of the shadows and into the light. This sudden materialization of invisible debt prompted Senate Democrats to formally demand answers from major credit bureaus in May 2026, just trying to ensure their scoring models treat consumers fairly as these hidden obligations suddenly pop up on their files.
Section 6. Time to do the math. Calculate your invisible balance.
It took the Austin designer 7 long months to dig out and pay off her invisible debt. But she said the hardest part of all was unlearning the lie that the interface told her every single time she checked out. And you have to recognize the linguistic sleight of hand being played on you here. The button says pay later. It does not say borrow now. The entire system is meticulously, psychologically engineered to remove the friction of borrowing, specifically preventing you from doing the math and feeling the weight of the debt you are actively taking on.
So, I want to leave you with this final challenge. If you use these apps, you might be telling yourself right now that it's not really debt, right? That you're just splitting a payment. Well, I want you to open every app, add up every single active installment plan, write the total down on a physical piece of paper. This entire industry depends on you never doing that math. So tell me, what is your real number?